The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Okay, it is Friday the 12th of September. Welcome back, Jeremy. Good to have you here.
Hi, Gareth. Yeah, good to be back.
So it's been an interesting week, lots going on. I had the pleasure of visiting the UK's inaugural Private Business Awards last night, and the main talk of the evening was the LSE's Pisces market, where all these private companies might be able to sort of semi-list themselves. So Interesting to hear a bit about that. But what's been going on in the macro space?
It's a bit of a back-to-school feel, really. So the main issues are rising political division and uncertainty, growing tensions in the main theatres of war in the Middle East, with Israel bombing Qatar, and in Ukraine with Russia testing Poland and NATO more widely with their drone attacks. Economically, growing evidence of weakening labour markets and slowing economic growth generally, combined with a persistence of inflation. But despite all those things, rising markets and increasing signs of healthier capital market activity in the UK, but more broadly, I'd say worldwide, actually.
Yeah, no, it certainly feels that way. There is a bit more positivity. There are a couple of IPOs beginning to happen, and it feels like there's certainly more activity than there has been. And you're right, it's interesting that contrasts with what feels like a steadily more worrying economic position.
Well, of course, as bond investors returned to school last week, they had to sort of face the talk of fiscal cliff edges, both for the UK and for France, of course. And, we had what Trump has described previously as some bond market yippies, which seem to have calmed down a bit now. But the one sort of thing I would point to, if the UK was just about to visit the IMF for a bailout, no one seems to have told the currency market. And the pound's doing fine, thank you very much.
How do you think they've achieved that? How do you think that's happened over the last sort of week or so?
Well, of course, the measure of a currency is all relative. And in that context, Trump's making us all look good. So deliberately or otherwise, the US Treasury are quite happy to see the value of the dollar lower, and the dollar has continued to weaken. So that does two things. It's better optics for sterling and for other currencies, because we all measure ourselves in terms of how we are doing relative to the dollar. But it also loosens financial conditions. So part of what is going on here is the US policy of trying to outgrow the debt. And a key plank in that is to take one's foot off the inflation brake. So while that means that risk assets have started to perform, investors are hedging themselves, and that's reflected in what I would argue is the ultimate measure of value here in terms of the rising gold price and other precious metals.
No, that makes sense, because that's not a bad medium-term way for things to happen. If that can persist for a number of quarters or years, then the US could help everybody effectively inflate their way out of their various debt problems. But as you say, in that world, what you want to own is the one thing which isn't relative, which is gold or Bitcoin or something like that, I guess.
Gold, silver, Bitcoin, maybe platinum. Yeah.
And what about economic data? Have we had much coming through from the big economies?
So, US jobs growth slowed significantly in August, and there's been all kinds of politics around the measurement of labour market data. But there does seem to be a decisive trend in the US for a weaker labour market. I think the bearish interpretation of this indicates that the recession that some in the markets have been fearing for a while probably started several months ago. The historic revisions to the non-farm payrolls indicate that May and June this year went from positive to negative. But of course, the flip side of that, the interpretation of that is that obviously that bad news is good news. And this just means that we get the likelihood of lower rates quicker and a faster trajectory of lower rates as well.
Yeah, the US economy on lots of metrics does seem to be slowing. But then you've got the big tech names still hugely up across the year in terms of performance and still performing very well as businesses. And I suppose there was always that slight worry that if the performance of the markets is so concentrated in the hands of, a relatively small number of companies, especially where those companies, their revenue is other people's capex. And that can reverse very, very quickly if people change their views on what return they're expecting on their capital or what they're prepared to invest in.
Yeah, I think the sentiment around the Mag 7 or, the 10 largest stocks is very uncertain and quite fragile. And you saw it with the remarkable performance of Oracle that updated the market this week, making Larry Ellison now the world's richest person. I think it was something like a 30% appreciation in the Oracle share price this week on the basis of him saying, hey, I'm involved in the AI arms race as well. But amidst all that euphoria, you've got a drumbeat of where's the return on investment for the AI proposition? Everyone's doing it. Everyone's saying that it's something they must do, but where's the cash?
Well, it's being spent on NVIDIA chips or Oracle licenses by the look of it. But
yes.
You're right.
Yes.
At some point, there needs to be a return on that. There needs to be some kind of customer-facing business that generates revenue and profit and cash.
Yeah.
And there aren't many business models yet that have really shown that value being delivered.
But meanwhile, these financial assets represented by the Mag 7, it's something like 40% of the S&P 500. Now, when that unwinds, that capital needs to go somewhere. And how the world copes with that reallocation of capital and the timescale in which it happens, I think is the critical factor for financial markets for the foreseeable future.
Yeah. In terms of where it might find that home, where do you think the political or the economic landscape is more attractive or is guiding people to put that capital? We've got stuff going on in Europe or other geographies that could attract capital?
I think emerging markets tend to do well when the dollar weakens, and China's up something like 50% over the last 12 months now. Pockets of value in developed markets, I would include things like Japanese smaller companies and also the UK. I think that is why you see this divergence between how economies might perceive to be performing and how stock markets perform. So amidst the political turmoil that has been going on in recent weeks in Westminster and the headlines around what's going on in the UK stock market seems to be doing okay.
Okay, yeah.
My reaction to hearing the date of the budget, which I think is sometime towards the middle of November, so it's a long old haul. And of course, as investors, if we're going to get bad news, let's get it out there so we can understand it and adapt to it. And while that is a natural concern, the bullish interpretation of what is going on is that whatever you make of the turmoil that our government is going through at the moment and the loss of our deputy prime minister, which incidentally looks to me like an inside job, is that it now gives Starmer the chance to reset the government and reset the economy for growth. They're going to pull some rabbits out of the hat. Now, the other interpretation is that they're stringing out as long as they can because they haven't got a clue and they're hoping things will get better. And amongst those things, as we've already mentioned, is if the dollar continues to weaken, it gives the ability for us and other economies then to reflate themselves slightly on the back of that dollar weakness.
And if we saw, long-term treasury gradually declining, mortgage rates coming down, you could see a positive outcome to a lot of this.
Oh, sure. And the direction of travel for interest rates in that period is going to be lower.
Yeah.
The short-term rates. And the US 10-year treasury is back in sighting shot of 4%. But if that 10-year yield falls materially below 4%, gilt yields will be dragged down with it. So if they do string it out, the macro backdrop can improve here. But it's obviously a frustrating wait for investors because it's sort of waiting for the inevitable.
And while we're waiting for the inevitable, various companies are reporting. We've had a slew of news this week.
Yeah. Being back at school, we're getting the more regular fill of results reports and updates. Yeah. I mean, we've had some notable warnings, and I think probably chief among those was the Warpaint profit warning, which was very company specific. More broadly, as far as it sort of indicates what's happening in the UK consumer economy, well, we had AB Foods that talking about Primark doing okay in the UK, doing okay in the US, but got a few issues in Europe. We've had Gym Group saying that they guided their forecast to the upper end of the range of expectations. We had a positive update from Wix in the DIY space. So obviously there's company-specific stuff going on, but it indicates that UK companies have adapted to where the UK consumer is, and the UK consumer is in an okay place. In aggregate, the problems of debt in this country aren't to do with private sector debt, with consumer debt. It's to do with public sector debt. And the UK consumer is still able to spend when they see the right opportunities.
No, you're right. Well, we've talked about a number of times as the resilience, the flexibility, the adaptability that UK PLC has had to exhibit over the last many, many years for all the various different reasons. But if that's correct, and if the UK consumer is not getting worse in terms of sentiment, then yeah, they could really perform pretty well, some of these consumer-facing stocks. We also looked at Treat. You saw the modest premium that was offered to the shareholders of Treat. It's a business I know you've been watching for a while.
Yeah. So Treat's gone from being a stock market darling to being very much a problem child. I mean, share price from memory down sort of 90% from the high. Yeah, this is an ingredients provider into the supply chain for the food manufacturing industry, where it provides fragrances and flavors. And it has historically performed that function very well. It's had a number of issues relating to CapEx plans, and it's had a couple of management changes, but it's continued to retain investor support. And I think it was very disappointing for all involved to see the board of Treat accepting the first offer that comes along with the share price much closer to the lowest point of its ever valuation than the highest point of its ever valuation, and accepting a modest premium of just 16% to its prevailing share price. Now, that either reflects the management not fully telling the world the nature of its structural problems, or there's something else going on here.
So yeah, it is interesting, and it looks like a very opportunistic bid from some clever people, presumably. But it will be interesting to watch and see whether there's a counter bid or additional interest on the back of what's happened. Okay, and what about the next week or so? What have we got coming up?
Well, there's going to be a big focus on Wednesday for next week. We got the UK's inflation print for August. I think the expectation is that it's going to be a number that could be higher than the print for July, which was 3.8%. So that could be a bit of a scary moment. But later in the day on Wednesday, we get the big one, which will be the Fed rate decision. I don't think there's much debate now that there will be a cut. I think it's almost certainly going to be 25 basis point cut. I think anything bigger would run the risk of scaring the horses. But as ever, the focus will be on the context in terms of what is communicated at the press conference after the decision is announced. And clearly, Jay Powell is a man who's been under personal attack from Donald. And increasingly, the attack on the Fed is now being taken up by Scott Bessent, who is adopting a much more structural ideological approach to the very existence, or at least independence, of the Fed. And I think whether it's now or sometime in the future after Jay Powell's term ends, things are going to look very different. And I think we will be looking back and seeing that this is the period where the whole concept of independent central banks sort of disappears into the sunset. But also coming up next week, we've got an inflation print from Tokyo in Japan on Friday, which is expected to show a small reduction from the July figure of 3.1%. Japan, its government is in flux. The Prime Minister of Japan resigned last weekend. Given its high level of indebtedness, Japan retains the ability to light the match for the next financial crisis, in my opinion. I've been saying it for a while. We had a sort of trial balloon last year, and some people are saying that's just the precursor to the main event that's yet to come. So keep an eye on that one. But looking ahead next week, I'm leaving the country, as you know, over the weekend, but we have the arrival of Donald Trump for his unprecedented second state visit to the UK, with the prevailing ghost of Jeffrey Epstein hanging in the wind over the site of Keir Starmer and his colleagues, obviously trying to keep Peter Mandelson and presumably Prince Andrew out of the way of the Donald. So I think that that's going to be the main event in the week ahead.
So yeah, you'll be trying to almost completely ignore whatever Donald says, bluster their way through it. So yeah, we'll catch up on that once you're back. So yeah,
okay,
great talking to you, and we'll talk soon.
Bye for now.
Bye.
Brought to you by Progressive Equity.